Hello, everyone. Welcome to the weekly lecture videos once again. And this is the last video this week. In this video, we are going to cover the third learning objectives of this chapter, evaluating NPV estimates. If you recall, as we discussed in the last chapter, chapter 8, an investment has a positive net present value if its market value exceeds its cost. And such an investment is desirable because it creates value for its owner. The primary problem in identifying such opportunities is that most of the time we cannot actually observe the relevant market value. Instead, we estimate it. Having done so, it is only natural to wonder whether or not our estimates are at least close to the true values. Okay, so we discuss this question in this video. So what's the basic problem? Suppose we are working on a preliminary discounted cash flow analysis along the lines we learned in the previous videos in this chapter. We carefully identify the relevant cash flows, avoiding such things as sunk costs, and we remember to consider working capital requirements. We add back any depreciation, we account for possible erosion, and we pay attention to opportunity cost. Finally, we double check our calculations, and the bottom line is that the estimated NPV is positive. So now what? Do we stop here and move on to the next proposal? Probably not. The fact that the estimated NPV is positive is definitely a good sign, but more than anything, it tells us that we need to take a closer look. Okay, if you think about it, there are two circumstances under which a discounted cash flow analysis could lead us to conclude that a project has a positive NPV. The first possibility is that the project really does have a positive NPV. That's a good news. And the bad news is the second possibility. A project may appear to have a positive NPV because our estimates are maybe optimistic or inaccurate. Okay, that gives rise to forecasting risk or estimation risk. Okay, so look, what is this? The key inputs into a discounted cash flow analysis are projected future cash flows, right? If these projections are seriously in error, then we have a classic GIGO, garbage in, garbage out system. In this case, no matter how carefully we arrange and manipulate the numbers, the resulting answers are still grossly misleading. This is the danger in using a relatively sophisticated technique like discounted cash flow. Okay, it is sometimes easy to get caught up in number crunching and forget the underlying nuts and bolts economic reality. Okay. The possibility that we will make bad decisions because of errors in the projected cash flows is called forecasting risk. Okay, because of forecasting risk, there is the danger that we will think a project has a positive NPV when it really does not. How is this possible? It occurs when we are overly optimistic about the future, and as a result, our projected cash flows do not realistically reflect possible future cash flows. Okay. So far, we have not explicitly considered what to do about the possibility of errors in our forecast. So our goal is to develop some tools that will be useful in identifying areas where potential errors exist and where they might be especially damaging. Okay. The next point is sources of value. Look, the first line of defense against forecasting risk is simply to ask, what is it about this investment that leads to a positive NPV? We should be able to point to something specific as the source of the value. For example, if the proposal under consideration involved a new product, then we might ask questions such as following. Are we certain that our new product is significantly better than that of the competition? Can we truly manufacture at lower cost? or distribute more effectively, or identify undeveloped market niches, or gain control of a market. These are just a few of the potential sources of value. There are many others. A key factor to keep it in mind is the degree of competition in the market. It's a basic principle of economics that positive NPV investment will be rare in a highly competitive environment. Therefore, proposals that appears to show significant value in the face of stiff competition are particularly troublesome. The point to remember is that positive NPV investments are probably not all that common, and number of positive NPV projects is almost certainly limited for any given firm. So if we cannot articulate some good economic basis for thinking ahead of time that we have found something special, then the conclusion that project has a positive NPV should be viewed with some suspicion. Okay. Our basic approach to evaluating cash flow and NPV estimates involve asking what-if questions. Accordingly, we discuss some organized way of doing that. And the first one is a scenario analysis. The basic form of what-if analysis is called scenario analysis. What we do is investigate the changes in our NPV estimates that result from asking such question. What if unit sales realistically should be projected at X instead of Y? For example, at 5,000 units instead of 6,000 units. Once we start looking at alternative scenarios, we might find that most of the plausible ones result in positive NPVs. In this case, we have some confidence in proceeding with the project. If a substantial percentage of the scenarios look bad, then the degree of forecasting risk is high and further investigation is in order. Okay. We could consider a number of possible scenarios. A good place to start with the worst case scenario. This tells us the minimum NPV of the project. If this is positive, we will be in good shape. Okay. To get the worst case, we assign the least favorable value to each item. This means low values for the items such as units sold, price per unit, or high values for cost. We do the reverse for the best case. Okay. And once we have this type of estimates, then we can calculate NPV under different scenarios. The term best case and worst case are very commonly used, and we will stick with them, but should note that they are somewhat misleading. Okay, the absolute best thing that could happen would be something absurdly unlikely, such as launching a new diet soda and subsequently learning that our formulation also happens to cure the common cold. Of course, on rare occasion, then these things do go very, very wrong. Okay. Instead of best and worst, it is probably more accurate to say optimistic and pessimistic. In broad terms, if we were thinking about a reasonable range for, say, unit sales, then we call the best case would correspond to something near the upper end of that range, and the worst case would simply correspond to the lower end. Okay. As we have mentioned, we could examine an unlimited number of different scenarios. At a minimum, we might want to investigate 2 intermediate cases by going halfway between the best case and the extreme case. This would give us 5 scenarios, including the base case. Okay. Beyond this point, it is hard to know when to stop. As we generate more and more possibilities, we run the risk of paralysis of analysis. The difficulty is that no matter how many scenarios we run, all we can learn are possibilities, some good and some bad. Beyond that, we do not gain any further guidance as to what to do. So look at an example of a scenario analysis. For example, you can see that unit sales base case is 6,000. So the lower bound is 5,500 and upper bound is 6,500. So you can see this lower bound and upper bound can be considered as worst case and best case, or pessimistic and optimistic, respectively. Per unit also has a lower and upper bound, so is variable cost and fixed cost per unit. Okay, so putting these base case lower and upper bound informations in our cash flow estimation, we can calculate our NPVs in these scenarios. Okay, so for example, you can see that our base case NPV is positive, so is our best case, but our worst case NPV is negative. Okay, and worst case IRR is also negative. Okay, so that gives us some idea that what might go wrong, and we also can understand that to which scenarios or to which variable the NPV is more sensitive to. Okay, so scenario analysis can give us some idea that how the worst can go if the project goes wrong. Okay. So scenario analysis essentially useful in telling us what can happen, in helping us to gauge the potential for disaster, but it does not tell us whether or not to take the project. Okay. Now, the sensitivity analysis is a variation on scenario analysis that is useful in pinpointing the areas where forecasting risk is especially severe. The basic idea with a sensitivity analysis is to fridge all of the variables except one, and then see how sensitive our estimate of NPV is to change in that one variable. If our NPV estimate turns out to be very sensitive to relatively small change in the project value of some component of the cash flow, then the forecasting risk associated with that variable is high. Okay, keep it in mind that the major difference between a scenario analysis and the sensitivity analysis is, in a scenario analysis, we consider a scenario that, for example, an optimistic scenario will be higher price per unit, lower cost, lower fixed cost, higher market share. So that's a whole package, okay, that makes up a scenario, worst case or best case. Okay. In sensitivity analysis, on the other hand, we do not consider multiple variables. Rather, we keep all variables unchanged and manipulate one variable only to see how sensitive an NPV is to that particular variable. Okay, and if we see that NPVs are sensitive to a particular variable, it means that that variable is more important. So it should be cautious in estimating the cash flows associated with that variable. So you can see here, for example, sales units and cash flow, net present value. So everything else remain the same. Only changes made are number of sales units. So you can see in base case, it's 6,000, worst case 5,500, and best case is 6,500. And we calculate NPVs and IRRs. Okay, so essentially we should have a sensitivity analysis for each of the variable changes. For example, sales unit, price per unit, variable cost per unit, and so on. And we want to see that to which variable the NPV is most sensitive to. And we have, as I mentioned, that we have to be careful about when we estimate NPV based on some estimation of that variable. Okay. So you can see here that the NPVs for fixed cost changes, and you can see the net present value here. Sorry, net present value here. And you will see, if you compare here the net present values, and if you compare net present values here, I think you understand that that NPV is more sensitive to unit sales than fixed costs, right? Because you see that in the case of the fixed cost, even in worst case, the NPV is positive, whereas in the case of unit sales changes, the worst case NPV was negative. Am I right? As we understand that sensitivity analysis is useful for pinpointing those variables that deserve the most attention. Okay, if we find that our estimated NPV is especially sensitive to a variable that is difficult to forecast, the degree of forecasting risk is high. We might decide that further market research would be a good idea in this case. Okay. Because sensitivity analysis is a form of scenario analysis, it suffers from some drawbacks. And sensitivity analysis is useful for pointing out where the forecasting error will do the most damage. But once again, it doesn't tell us what to do about possible errors. Okay. So these are the points that I just discussed. So to summarize what we have discussed so far, as we were talking about sensitivity analysis and scenario analysis, you notice that we have considered some simple case and some simple variations. However, you can use sophisticated model and you can consider numerous possibilities. Okay. However, you need to remember that you shouldn't be caught in analysis paralysis that I discussed previously, because too many alternatives will provide you alternative NPVs. However, that not necessarily will tell you that where to stop and what decision should be made. So at some point in time, you have to make a decision. Okay. So if majority of the scenarios you are considering lead to positive NPV, that is a comforting point about accepting a project. Okay. And as I mentioned, that if you see that a crucial variable leads to a negative NPV for a small change in the variable, that you may forego the project or you may postpone the project for the time being and do more research about that variable, about estimating that variable. Okay, the next point we are going to talk about is the managerial or real options. So that's our final task in this chapter. So in our capital budgeting analysis thus far, we have more or less ignored the possibility of future managerial actions. Okay. Implicitly, we have assumed that once a project is launched, its basic features cannot be changed. For this reason, we say that our analysis is static. Okay. In reality, depending on what actually happens in future, there will always be ways to modify a project. Okay. We will call these opportunities managerial options or real options, because they involve real assets. For example, the fixed assets or so, these options are called real options. There are a great number of these options. The way a product is priced, manufactured, advertised, produced can all be changed. Okay, we discuss some most important managerial options. First of all is contingency planning. Look, the various what-if procedures in these chapters that we discussed previously have another use. We can also view them as primitive ways of exploring the dynamics of a project and investigating managerial options. Okay, what we think about in this case are some of the possible futures that could come about and what actions we might take if they do. For example, we might find that a project fails to break even when sales drop below 10,000 units. This is a fact that is interesting to know, but the more important thing is to go on to ask, what actions are we going to take if this actually happens? Okay, so this is called contingency planning, and it amounts to an investigation of some of the managerial options implicit in a project. Okay. So what we can consider is, for example, option to expand, option to abandon, option to wait, and so on. Okay. So let me very briefly talk about each of these points. Option to expand. One particularly important option we have not explicitly addressed is the option to expand. If we truly find a positive NPV project, then there is an obvious consideration. Can we expand the project or repeat it to go an even larger NPV? Okay, our static analysis implicitly assumes the scale of the project is fixed, as I mentioned previously. For example, if the sales demand for a particular product were greatly to exceed expectation, we might investigate increasing production, right? And if these were not feasible for some reason, we could always increase cash flow by raising the price. Okay. Either way, the potential cash flow is higher than we have indicated. Overall, because we ignored the option to expand in our analysis, we underestimate NPV, as in our previous analysis. At the other extreme, the option to scale back or even abandon a project is also quite valuable. For example, if a project does not even cover its own expenses, we might be better off if we just abandoned it. Okay, our DCF, discounted cash flow analysis, implicitly assumes that we would keep operating even in this case. In reality, if sales demand were significantly below expectations, we might be able to sell off some capacity or put it another use. Okay, and maybe the product or service could be redesigned or otherwise improved. Okay. The last point, option to wait. Implicitly, we have treated proposed investment as if they were go or no go decision. Actually, there is a third possibility. The project could be postponed, perhaps in hope of more favorable conditions in future. We call this the option to wait. More generally, as long as there is some possible future scenario under which the project has a positive NPV, the option to wait is valuable. Okay. Oh, there's another one. Another point is strategic options. Companies sometimes undertake new projects just to explore possibilities and evaluate potential future business strategies. This is a little like testing the water by sticking a toe in before diving. Such projects are difficult to analyze using conventional DCF methods because most of the benefits come in the form of strategic options, that is, options for future related business moves. Okay. Projects that create such options may be more valuable, but that value is difficult to measure. Research and development, for example, is an important and valuable activity for many firms precisely because it creates options for new products and procedures. Okay. To summarize, we have seen so far that incorporating options into capital budgeting is valuable, but it's not easy. Okay. So what can we do in practice? The answer is that we can only keep them in the back of our minds as we work with the projected cash flow. We will tend to underestimate NPV by ignoring options. The damage might be small for a highly structured and very specific proposal, but it might be great for an exploratory one. Okay. Now let's spend some time on a relevant topic, which is capital rationing. Capital rationing is said to exist when we have profitable investment available. Profitable investment means positive NPV investment available, but we cannot get the needed funds to undertake all of them. Okay. For example, as divisional managers for a large corporation, we might identify $5 million in excellent projects, but find that for whatever reason, we can spend only $2 million. Okay. So what can we do? So first of all, let's talk about these capital rationing scenarios. Soft rationing, the scenario that we have just described is soft rationing. Okay. This occurs when, for example, different units in a business are allocated some fixed amount of money each year for capital spending. Such an allocation is primarily a means of controlling and keeping track of overall spending. The important thing about soft rationing is that the corporation as a whole is not short of capital, but more can be raised on ordinary terms if management so desires. Okay, so if we face soft rationing, the first thing is to try to get a larger allocation, and failing that, one common suggestion is to generate as large an NPV as possible within the existing budget. Okay, and the amounts of choosing those projects with the largest benefit cost ratio, the profitability index. You might remember we learned about profitability index in the last chapter. Okay. The next one is hard rationing. With hard rationing, a business cannot raise capital for a project under any circumstances. For large, healthy corporations, this situation probably does not occur very often. This is fortunate because with hard rationing, our DCF analysis breaks down and the best course of action is ambiguous. The reason DCF analysis breaks down has to do with the required return. Suppose we say that our required return is 20%. Implicitly, we are saying that we will take a project with a return that exists. However, if we face hard rationing, we are not going to take a new project no matter what the return on that project is. So the whole concept of a required rate of return is ambiguous. About the only interpretation we can give this situation is that the required rate of return is so large that no project has a positive NPV in the first place. Okay. Hard rationing can occur when a company experiences financial distress, meaning that bankruptcy is a possibility. Also, a firm may not be able to raise capital without violating a pre-existing contractual agreement. Okay, we will discuss some of these situations in some future weeks. Okay, so this is the end of this video, and that's also the end of this chapter. So if you have any question, any problem with any of the topics, don't hesitate to let me know. Thank you very much.